Hello, everyone. Welcome to our discussion of Chapter 4. We're actually talking about how do we get to adjusted gross income. So in Chapter 2, we mentioned how important adjusted gross income was, AGI, as a measure because it's used to calculate other credits, other deductions besides just the ones that it includes. So the things we talk about here are things that are subtracted out. Now, we talked in Chapter 3 about things that are actually never included. So these are ones that would be included in income and then we would deduct for them, but before AGI. So it's not only going to affect taxable income, but also adjusted gross income. These are you might say, the most valuable deductions as they stands because they have that dual role of reducing income and increasing credits or other tax deductions. So as we look at this is the Schedule 1 for 2020. And this is basically some additional income items up top in Part 1. In Part 2, these are the adjustments for AGI. These are the deductions that come off first, the For AGI deductions. Now, the ones I have circled here are going to be discussed, not going to be discussed in this chapter. Either they'll be talked about in a different chapter or won't be discussed at all. So the plans, line 15 and 19, those are all retirement type deductions. And we have a whole chapter 11, on retirement plans. And so we'll hold discussing those until Chapter 11. Line 11 sometimes gives students a problem, and that's because before 2017, there were business expenses that you could take, like mileage and such, on as part of your itemized deductions. And the Form 2106, as referred to here, was used to report that. Now, the Form 2106 is only for a very, very small group of people. The business expenses for reservists, performing artists, and fee-basis government officials. So reservists, those that are in the Army or Navy reserves, and their travel and things could be used on Form 2106. Performing artists, like a musician or something, and fee-basis government. So it's a very narrow. For everyone else, this is not going to happen. Okay, and there is this Form 2106 doesn't get used by other folks other than that very narrow thing. So if you find yourself actually thinking that you should be using the Form 2106 or something in a tax return or using line 11, chances are you are using old information or something like that, and you're looking at it when it really is only for this very narrow group of folks. So, in no particular order, we'll look at the other ones on that form. Okay, first one, perhaps maybe the most applicable to students, is student loan interest. All right, so it has to fit in, be a qualified education loan used to pay for educational expenses. The max is $2,500. Okay, so there's no matter how much you pay in interest, the most you could actually deduct is $2,500, and this is interest you pay on the loan after you're out of school per se and out there earning and paying back the loan. So here's what it needs to be used to be paid for. Now notice it doesn't have to be legally a student loan. You didn't have to go through the student loan process. Technically, now if you used some other form of loan for all these education, it would qualify. You are subject to probably a little more scrutiny because the IRS may question that, given that it's not a formal student loan. All right, so those tuition fees, books, supplies, equipment, room and board, and transportation is also part of the deal, okay, which other education benefits are not. So that's a broader thing than some other definitions. Have to be paid within a reasonable period before or after the loan date, so you have to be able to see that the loan actually goes to it, okay? And you got to be at least half full-time student. Can't be just one class here and there, and it has to be on an attended course of study, meaning that you can't just be for personal enrichment. Doesn't matter if it's undergraduate or graduate. We see that other credits are only for undergraduate, but this could be either way. Okay, and then it is reduced, limited based on your AGI. So here's one of our examples of if your AGI is too high before you consider the student loan interest, right? Then you could be disqualified or have only part of that $2,500. So this is the limit. $140,000 on a joint return, $70,000. Okay, so $140,000 if you're married filing jointly, and then it phases out, starts phasing out at $140,000. It's completely phased out when it's reached $170,000. So if your AGI is over $170,000, then you get no benefit from your student loan interest, no matter what how much you paid. So your first limit is could only be of $2,500. And then it's reduced based on your AGI potentially. If you're under $140,000 joint return, and the same difference for single, then you can have the whole $2,500 or up to the $2,500. Okay, so if you have AGI between 140 and 170, then you take your student loan interest deduction up to $2,500, right? If you're paid less than $2,500, obviously that's the number you use. You multiply by this fraction to see how much is disallowed, and then subtract that off your original. Okay, so that's how you calculate how much it is. So between 140 and 170 for married filing jointly, you're going to have a part of whatever the interest you paid. Okay, after you've already applied the $2,500 limit. Second item on Schedule 1, or that could be deducted, is contributions to a health savings account. Now, this is sort of like a retirement plan, IRA. It's an tax-exempt saving account, meaning that the interest it makes isn't taxable income, and it has to be used for qualified medical expenses. So you put money in, and then the only reason you pull it out is to pay medical expenses. All right, and this is a For AGI. You can use it for you or your spouse or dependents for qualified medical expenses. And of course, there's a list of those. We'll get more into that in Chapter 5, because we'll use the same definition as we have in Chapter 5 for medical expenses. You have to be either self-employed, or you have to be with an employer that provides a high deductible health plan. Okay, so it's not for everybody. You can't just create this HSA unless you have a high, and that means that you have insurance, but it doesn't kick in until you reach the deductible, and those deductibles are fairly high. Okay, and you can't have any other health insurance. All right, and you can, except for things that cover disability, dental care, that sort of thing. So here is the limits. The deductible, to qualify as a high deductible plan, the minimum deductible is $1,400. It can be higher than that, but it can't be any less than $1,400 if you're an individual and family, $2,800. So that's a pretty high deductible, okay? And then there also must be a maximum deductible and out of pocket. So typically on insurance, there is the deductible, and then there is what you total that you'll have to pay out of pocket. So you meet your deductible, and then the plan pays 80%. And at some point, you have your amount that you have shelled out between the deductible and the 20% you have to pay. When it reaches a maximum, then the insurance pays 100% from there on. Okay, and to qualify as a high deductible plan, there must be this maximum limit, okay, where you stop paying the 20%, and those are your limits as shown on the slide. That's what it has to be a qualified high deductible plan. Okay, so when you put it in or pull it out, you'll get a form 8889 from the holder of the account. So you can't just you have to set up a separate account from your regular savings and things like that, and it has to be specifically for an HSA. They will send you a record of, similar to a W-2 or 1099, of what happened in the plan. Okay, and you don't include this money when it comes out. You get a deduction when you put money in, and it doesn't income when it comes out. So it's a good deal. Okay. All right. So there were some old plans called Archer MSAs. Okay, but most of the time, HSA is a better deal, so most people have converted those over. Okay, and you have to have a trustee. You have to have someone who is going to make sure that the paperwork is done, that takes control, that has actual control of those assets. You can't just have them under your mattress or something as a savings account. All right. The next one is moving expenses. We're going to go through this pretty quickly because they limited this in 2018 to only members of the armed forces. So it used to apply, these rules are still the same as they were before. And this may go away. The tax law does expire in 2025. So we might go back to the old rule. So the rule kind of stays the same. They just said, you can't do this unless you're full-time military. And so here's the definition that fits now. It used to be anybody moving a certain amount of distance away from their home would qualify, but now it is only the military, members of the military. Okay? So if you spend the money on the move and you get reimbursed, it's not income. Okay, you see what some of the things that are included. All right, that could be, if you get reimbursed, it shows up on W-2. Okay, the cost of actually moving across the country, lodging on the way, driving your car, that sort of thing, are all part of the cost of moving. So moving the people, flying them if you do buy an airline ticket, mileage on your car, okay, rental of a truck, storage of stuff on the way, that sort of thing was all included in your moving expense. You can either, not meals, okay, but lodging, out of pocket, you can keep track of all your receipts, or you can just figure out the mileage and take 17 cents a mile for your vehicle. If you rent a truck, then you're going to be paying a lot more than that to the rental company, and that's what you're going to deduct. And you don't get to deduct that and the 17 cents. You'll deduct the gas you put into that truck. You'll put the mileage per mile cost that you pay for that truck, that sort of thing. Parking fees and tolls always go on top of the standard mileage rate, but the standard mileage rate covers everything like insurance and gas and all that type of stuff. And then foreign moves get a little include some additional things. Again, that is specific to the military situation.